Okay, welcome to 22-4 Part 2, where we're going to be doing our reversing entries for the ending of our fiscal period. So remember that when we're talking about reversing entries, I just want to pull up as a reminder when reversing entries are used. So remember that we use reversing entries anytime that an adjusting entry creates a balance in an asset or a liability account that initially had a zero balance. That's when we use a reversing entry. So what we need to do when we're thinking about our APLIA here is notice that they put our adjusting entries here so that we can look at all of those. They also have our adjusted trial balance on our chart of accounts if we need that. And it just says that using the information in our question assets, we're going to journalize the reversing entries for the following year for our Travelite Corporation on page 14 of our general journal. So remember that when we're doing reversing entries, that just like adjusting and closing, they do not have a document number. So you do need to make sure you put this heading reversing entries up there, particularly if you would be doing this for like a workbook problem or a reinforcement. You would want to make sure that you put that. Otherwise, we don't know what those transactions are because there are no document numbers that are going to be associated with them. So also remember that reversing entries are always done on the first day of the new fiscal period. So that's technically January 1st is going to be our first date for a reversing entry. So as we start scrolling through our adjusting entries, we need to think about which ones affected either an asset or a liability account that originally had a zero balance. And our first one that would do that is our interest receivable and interest income. So remember that with interest receivables and interest income, with a reversing entry, we're just flip-flopping that. So instead of interest receivable being debited, it will be credited, and interest income will be debited instead of credited. So we come in here and we put interest income, $137.50 for the debit, and then interest receivable is going to be credited for $137.50. And all that allows us to do is remember that we haven't actually received that money yet. So if we hadn't have done a reversing entry, we very likely could have double counted the amount because we have to do this for accrual basis, again, to bring everything up to date at the end of the fiscal period. And if we don't flip this, this income of $137.50 was already counted in the last fiscal period, and it would be double counted in this upcoming one. So let's keep looking, scrolling to see if we can find our next one. And that is going to be our interest expense and interest payable. Again, interest payable had a zero balance at the end of the fiscal period, and then we did our adjusting entry. So this one needs to be flipped. So we just put the first in here. So what happens is interest payable is going to be debited for $277.58, and then interest expense is going to be credited for $277.58. And those are the only two reversing entries that we did in the past. But remember that one more that needs to be flipped here is going to be our federal income tax expense. Because if you remember, federal income tax payable had a zero balance at the beginning of, or at the end of the year. So we need to do a reversing entry on this one as well. So federal income tax payable is going to be debited for $7,521.44, and then federal income tax expense is going to be credited for the same amount. So those are our three reversing entries, and that should bring us to the end of our chapter 22 learning that we need to be able to complete everything. So with that being said, you can head on over and do your 22-4 on your own and your application problems.